you're an FHA lending expert, I just wonder what's the relationship between FHA and HUD? And can you also share with our audience what is FHA stand for, what is HUD stand for? Because most of our audiences, they're investors and they may not be very familiar with the terms.
Sure, absolutely. FHA is the Federal Housing Administration, and what they do is they write the rules for the FHA insurance program for multifamily and healthcare facilities. With these rules, they need someone to implement those rules, and that's where HUD, which is the U.S. Department of Housing and Urban Development, they implement the program and make sure that it's administered by the FHA guidelines.
What distinguishes a HUD loan from other commercial loans?
The biggest distinguishing factor is the insurance program itself. The biggest thing is like pack your patience with a HUD loan because it's a process and not a race. It's going to be very methodical. It's going to be step by step.
Welcome to Senior Living Investment with Emily Bowe. Today, I have great pleasure of introduce Jesse Stewart IV. Jesse is an FHA lending expert, specialized in multifamily and healthcare facilities financing. With over 11 years of experience, he excels in tailoring FHA lending solutions for commercial multifamily properties and healthcare facilities. Previously, Jesse worked as a senior underwriter at the U.S. Department of Housing and Urban Development for 7 years. Welcome to the show, Jesse.
Thank you. Thank you for having me. Happy to be here.
Could you provide some insights into your background?
Sure. As you said, really my multifamily experience comes directly at HUD. I worked in the Detroit field office, started off as a paralegal in the legal department, and slowly, after about a couple of years, HUD went through what's called transformation, in which they closed a bunch of small offices and then they consolidated their multifamily lending platform into a single underwriter model. And I applied for the position after talking to people who had worked in the division prior, and they said I'd be a good fit. So I applied and I got hired, and I did that for about 7.5 years until I left.
That's why I want to invite you to the show, because you have all this knowledge in terms of working with HUD and the ins and outs of using HUD loan for commercial real estate.
Yes.
And can you share any success stories or case studies where FHA lending significantly benefit a project or organization?
I don't have one in particular, but I will say that it has changed the way some people think about FHA lending because it's not a common product in this day and age for financing simply because of the inner workings of the programs. But it has helped a lot of people stabilize their cash flow in these properties because of the terms that are provided and the lower interest rates and the fact that these loans are fully amortized throughout the life of the loan. There is a less cost of finance because the terms are 35 years. So unless there's a dramatic change in interest rates, there's no need to refinance. And these properties are very much stabilized by these HUD loans because there's also oversight in which HUD holds the property owner and management company to a certain standard. And with those reporting requirements, these properties have to maintain a certain standard. And that's what I would say is the most transformational piece of this product, is that we can go longer with our cash flow as far as on the borrower side, but yet there is accountability for the way that the property is managed and there is oversight. That is a key element to what the HUD product is.
Since you're an FHA lending expert, I just wonder what's the relationship between FHA and HUD? And can you also share with our audience what is FHA stand for, what is HUD stand for? Because most of our audiences, they're investors and they may not be very familiar with the terms.
Sure, absolutely. FHA is the Federal Housing Administration, and what they do is they write the rules for the FHA insurance program for multifamily and healthcare facilities. With these rules, they need someone to implement those rules, and that's where HUD, which is the U.S. Department of Housing and Urban Development, they implement the program and make sure that it's administered by the FHA guidelines. FHA would be the law body that sets the rules, and HUD is the government body that implements those rules into the public. HUD is the liaison between FHA and the public. And HUD's main job is to administer the program, make sure that its borrowers are following the rules that are set out by FHA. And they also provide the oversight for the reporting and regulations that come along with the program. In a nutshell, FHA administers the rules and HUD implements them.
Thank you for explaining the differences between FHA and HUD, as well as the relationship between them. And what distinguishes a HUD loan from other commercial loans?
The biggest distinguishing factor is the insurance program itself, which is FHA is a mortgage insurance program. What that does is that an approved lender will be safeguarded from a default from a borrower, with their recourse being able to capture those losses through a claim through the insurance fund. Each property pays what's called mortgage insurance premium. That money goes into a fund to help safeguard other properties in the fund from default. But if that does happen, the lender can make a claim against the fund to recoup the losses of the loan that the borrower defaulted on. That's usually the last step. There's some steps in between that HUD will try to use to mitigate the problem, depending on what it is. Like, for instance, they may ask that another partner come on to the investment to help run the property, someone that has probably more HUD experience. But that is usually, the claim to the fund is usually the last resort, but it's the last remedy. And at that point, HUD usually takes the property over and deals with it then.
It sounds like the underwriting is a critical step for a project to be approved for how long? And you work as a senior underwriter for HUD. What was your step to make sure you safeguard the risk for FHA and the HUD?
Yeah, there are two program guidelines. One is called the MAP guide, which stands for Multifamily Accelerated Processing Guide, and the other is the Section 232 or Lien Program Handbook. That's for residential healthcare facilities. And those guides provide every aspect of the loan process when you submit an application to HUD. It's a lender's guideline to what would be acceptable and what would not be acceptable to HUD as the lender kind of processes the application to submit to HUD. As a senior underwriter working with HUD, I would basically be using the guide as a guide to my underwriting as well, because like I said, every step is outlined in the guide, but we also have to assess the risk. That risk is mitigated partially by those guides, but also there are risks that we as underwriters in our gut tells us that we need to address or assess or mitigate as much as we can. We have the guide that kind of guides us, but it's also kind of a gut feeling from each underwriter, because each underwriter has a different view of each application. Like if you give an application to 5 different underwriters, you may have 5 different opinions. There's also an element of risk that the underwriter has to assess in their assessment of the application that's not necessarily in the guide, but you kind of have to use your experience and common sense and kind of think things through. And we have senior level people in HUD that also help us too in different departments. So when an application comes in, we have input from the asset management side. Sometimes, depending on the project, if it's new construction, we would get an assessment from the economics division to see if the property makes sense since it's a new build. There are other components to just the underwriter that helps assess the risk, but the guide is there for everyone to see so that the process is transparent. Going in, the lender knows what HUD is going to expect. And that also helps with the application process to help streamline that too, because those rules, they don't change that frequently.
Mhm.
Once you know the rules as a lender, you know what to expect and you can look at a loan and you can tell, yeah, this may be good for HUD, or hey, we may have to take this the conventional route.
What do you think the difference between the underwriting of conventional loan versus
Mhm.
obtaining a HUD loan, like in terms of the underwriting process? Do you think one is more stringent than the other?
I would say that that's kind of a case by case basis, but I think that HUD's underwriting standards are probably more stringent than what the conventional side is. And that's simply because of the regulations that are in place. For instance, HUD will require a repair escrow be set up if the property needs repairs prior to closing. HUD will require that you make critical repairs to the property prior to closing, but the non-critical repairs can be escrowed and must be completed within 12 months of closing. There's also a monthly deposit to a reserve for replacement account. And that is simply a reserve based on life schedule that the capital needs assessor looks at. So the capital needs assessor will look at every component of the apartment building, including appliances, roof systems, everything that can be basically depreciated in life in the apartment. And what they do is they come up with a recommendation schedule of the remaining economic life of those systems. And then what they do is they come up with an initial deposit in which a borrower would need to make that deposit at closing. And then they will come up with an annual and or monthly budget for how much cash flow needs to go into those reserves to fulfill the needs of those depreciated items so that when they do become unserviceable, that they can be replaced and that there's money set aside that they can use to replace those items. And what usually happens is they usually replace them out of the operation and then they'll submit the repairs receipts to HUD Asset Management. And then they will take a look at it and look at the reserves, and then they will approve it or disapprove it at that time. That's how kind of HUD safeguard themselves. Whereas a conventional loan, you may not have all those escrows. You don't have the reporting regulations. Another key thing from HUD is that you're only allowed to take owner distributions at certain times. Whereas a conventional loan, it may be whatever your operating agreement says that the lender agrees with. But HUD has a schedule and only certain type of borrowers can take profit distributions monthly, where most of them are done biannually. That's another key point, is that a lot of investors won't be able to access their cash flow immediately. They have to follow the schedule that is provided in the regulatory agreement that you sign with HUD.
Do you think if, say, a multifamily or a senior living facility, if it's actually funded by HUD, I see that for investor, it's less risk. And
Yes.
second, we may not get as much of a cash flow upfront because of all the rules and regulations that the lenders will have to comply by obtaining a HUD loan.
Yes, correct.
Okay.
Exactly.
My next question, since you mentioned that different underwriters, when they review an application, they may have different opinions. In regards of this, what's the standard process for a HUD loan to be approved? And do you have several underwriters to review the application? Or if not, like, would it happen, say, if one underwriter rejects, then the applicants may just appeal for it. Then we will have another underwriter to review the application again.
I think that when I was working at HUD, we tried our best not to deny an application. We rather work with the borrower and the lender to try to remedy any risk or mitigate any risk that we have seen. The main reason is because HUD really doesn't want to reject applications. Some of them we have to, but that's not really the goal, is to reject it. It's really to work with the borrower to see if they're willing to comply to certain requirements with HUD, because sometimes those get lost in translation with a conventional borrower going HUD. So HUD doesn't have a high reject rate for applications, but what it does do is it adds more time to the application process because of the back and forth negotiation and recommendations and changes that HUD may want to see. But it doesn't necessarily go to another underwriter. What happens is you usually get the senior director or the branch chief involved with the process to see if there's a remedy or something that the underwriter is not able to approve that they are able to approve, or to help open up conversation with the lender and the borrower about the application. That's really the process when it comes to HUD. Now, on the outside, on the lender side that I'm on now, we have a team of underwriters, if you will, that will work with the borrower throughout the complete process. So we're transparent in the fact that once you work with the underwriter, your direct communication is with that underwriter. And our underwriters have a lot of experience dealing with HUD, the various inner working. We can be a good guide to tell the borrower if the loan is a good fit for HUD or not. And then we can also manage expectations, because the HUD process is different than conventional. There's a lot more steps, a lot more time, a lot more paperwork. So there's more understanding that the borrowers need to have as far as the HUD process. So we definitely counsel our borrowers on the HUD product and the inner workings, and we manage expectations because it's not a quick process. We will have a relationship for at least a year, depending on what type of loan that the borrower is seeking.
So for anyone who is thinking to go with the HUD loan direction, they will probably really want to work with someone like you or your group to understand the expectation that they should have, and to help them to understand what kind of safety net that they should bake into the process while they're applying for HUD. Or maybe this is just not a good project for HUD, then you guys can also provide them the advice and maybe help them and redirect them to a different direction.
Exactly. Because the one thing I found is that we have a lot of conventional borrowers, but now that interest rates are a little bit out of the norm, as we would like to say, they look for the HUD product because they see the low LTV, they see the low debt service coverage ratio. But the one thing that they don't understand is the process and the time that it takes. As we spoke before, speed of execution is not a claim to fame for a HUD loan. You could probably do a conventional loan in 45, 60 days. That's just not going to happen with a HUD loan. That expectation is one of the biggest things besides the various fees that HUD would require. But if there's a patient borrower and they're willing to provide information and go through with the process, the end result of the HUD loan is very good for them, because they have a fully amortized loan. They have a 35 or 40-year and fully amortized term. Their cash flow is more predictable, instead of having to find and refinance after 5, 7 years, and you have to worry about interest rates where they are. That's not something that you can have to worry about if you can go through the stringent process that HUD has. The reward on the end is very much beneficial for investors.
Can I also ask who qualifies for the HUD loan? Is it only low income people, or like people working on Section 8 properties? Is it applicable to everyone who wants to apply for HUD loan?
So we're talking about a commercial, multifamily, or healthcare facility, not a single family or a condo or anything like that. That's a separate HUD program that a lot of people get confused with the multifamily and healthcare program. So as long as the person has multifamily experience and the property is 5 or more units, That's the basic qualification. Now, the property type, that qualification depends on the affordability of the project. So HUD does do market rate, but we also are a good companion to low income housing tax credits or Section 8 properties, senior facilities, healthcare. HUD's goal is to provide the best housing for the most vulnerable people in our population.
Mhm.
So HUD's focus would be on the residents and the sustainability of the project and not necessarily on the borrower. The borrower does get scrutinized, but HUD will take someone with no prior HUD experience, but they would require that, say, the asset management company probably has some HUD experience and or is willing to hire a consultant to help them through the first year of the regulations that HUD have, reporting regulations. If the property has the 5+ units and the owner has prior multifamily experience, you qualify to a certain degree. But there are other factors that are involved that are not really big hurdles, I would say.
What about the interest rates? What's the range of interest rates that offered by HUD loan?
Those vary depending on program. So the two main loan programs are the 223F and the 221D4. The 223F is a value-based refinance program. The 221 is a construction or substantial rehab cost loan. Those are two ways that you can get into the HUD program. Now,
Mhm.
after your project has HUD insurance or has gone through the program and has HUD insurance, there are a few other programs that are available to multifamily owners, such as the 241A, which would be almost like a second mortgage. Usually that's for projects that want to add additional units to their property. That's a good program for that. And then you have the 223A7, which is a strictly rate and term refinance. You're able to capture a lower interest rate than you have, but you're also allowed to extend your term back by, I believe, up to 12 years. So you can stretch the term out to help stabilize your income by adding more years back on your loan. So instead of paying 4% for remaining 25 years, you may be able to get 2% and stretch it back to 27 years. So now you have 27 years in which to utilize your 2% cash interest rate. And
Mhm.
that really can do a lot for cash flow. But
Mhm.
you also capture the low interest rate and you're able to extend the term so that you can actually own this property longer and enjoy that cash flow longer instead of counting down your years. So there are various other programs that can be utilized with the HUD loan. They're just not available to people who aren't already in the insurance program. So we get in with the 223F or the 221D4, but there's other low cost products that are out there that can be utilized to help keep the property inside the HUD insurance program.
Okay. From what you shared, I definitely see the advantage of HUD is first, low interest rates, and second, 35 of amortization. And it's non-recourse loan because it's backed up by the FHA insurance program.
Mhm.
But then the disadvantage, there's more upfront cost. Can you provide a rough idea in terms of what would be the percentage that we're thinking of in terms of upfront cost? Is it 10% of the overall purchase price, 5%? Do you have a number like that that you can share?
Yes, so it's a little bit of both. So like your application fee is 30% of your loan, whatever your loan is. The application fee for healthcare is 30 basis points of your loan. There are other costs that are associated, like your third-party reports. In order to get started, you would need to have a capital needs assessment done. You would need to have an appraisal done, and you will need a market study for a new construction. property on top of the appraisal and the capital needs assessment. And then there's an environmental study, a phase one, and sometimes a phase two that'll need to be performed. So that upfront cost can be significant. And that is something that is done with the lender. So if a borrower comes to me and they want to move forward, we would sign an engagement letter saying that we agree that we're going to engage to do a HUD loan. And then we would need the funds for the appraisal, the capital needs assessment, market study, or environmental study. And then when we submit your application, that's when you will need your 30 basis points to submit the application to HUD. So the upfront costs are a little bit more. That's just to get started. The closing fees are a little bit higher than a conventional loan. There's actually 3 attorneys engaged in the closing. You have the lender's attorney, the borrower attorney, and the HUD attorney. And then I mentioned before the initial deposit to the reserve for replacement, that has to come from upfront. That has to be deposited at the time of closing. And then the mortgage insurance premium as well. You have to pay an initial upfront premium, and then the rest of it is paid through the mortgage payment. The mortgage insurance premium is calculated into the interest rate. So you don't have to worry about making a separate payment. It's just know that part of your payment is going toward the mortgage insurance. So those are some of the fees that you will have to come up with. And it's all based on the loan amount that the borrower is seeking. And then the initial deposit and a lot of those other things are determined by those third-party reports that we get back from the environmental appraisal and the capital needs. Because the capital needs assessor will determine the R for R deposit and the annual deposits. Their recommendation is what HUD uses to come up with those figures. So it's not something that HUD just comes out of the air with. It's something that, a third party has said is needed to maintain the property.
I understand there's a 30% application fee. So say if one decide to withdraw, the 30% of the loan amounts would just go to HUD without any refund policy.
There are instances where it does get refunded. It says it's a non-refundable application.
Okay.
My experience is that only a handful get rejected. And so there's only a handful of refund requests. And again, HUD doesn't want to give the money back. There are extenuating circumstances in which they will. But HUD's thinking is that we're going to work with the borrower to come to a resolution so that we don't have to reject it and they don't have to lose their money. And a lot of onus is on the lender. So like for myself and my team, we have to work putting an application together knowing that if we submit this, that there's a possibility that it could get rejected and that the borrower would not get a refund for the application. So it's also up to us to make sure that we feel comfortable and the borrower feels comfortable in doing the HUD loan, because there is that risk of a non-refundable fee.
Would you be able to provide a rough range of the costs for all those reports that you mentioned earlier, say environmental appraisal? Like what's the rough cost for that?
Just using round figures off the top of my head, it all depends. For the appraisal and the capital needs assessment, it depends on the size of the property. So I would say for 100 units, you're probably looking at about $8,000 for an appraisal, probably about $10,000 for a capital needs assessment, and somewhere in the ballpark of 8 to 10 for the environmental assessment. And that's just for phase one. It could be a little bit more if there's an environmental determination that requires a phase two. Phase two may be double what the original price was for the phase one. And that's just a possibility, because now they have to go out and do soil borings. They have to actually go out on site. So that's going to add significant more cost and time to the report. But it's going to be good to have that up front when you submit to HUD so that they know that a phase two has been done and that there's a remediation program out there to mitigate any environmental risks that have been found on the property. So it could cost 20 to 30,000 easy upfront, and that's just to get the ball rolling. And then after that, we submit a package, then you have your application fee. So it is significantly costly upfront. And that's why we as a lender are going to make sure that the borrower is comfortable and that we are comfortable as a lender to provide that information to HUD, because it's a lot of money on the line and a lot of it is upfront. So we want to be sure that we don't waste any money, and we want to be able to maximize the time that HUD has to review, because like I said, this is a slow process when it comes to get to closing. So we want to be methodical in what we do.
Yes, that definitely makes sense. And I also wonder, since as a lender and previously as an underwriter, do you have any insight as of how can the borrower work with this lengthy time plus this high cost? Like, what would be the financing for them to be able to endure this application phase and plus this high cost upfront? Do you have any insight on that?
Only thing I can say is patience. Patience, and deal with a lender who can explain the process to you, is going to be upfront and going to let you know the ins and outs of what's going to happen. Because if you're looking for something that's going to close in 30 days, this is not going to be a fit for you. That's probably better suited for conventional. The biggest thing is time, is speed of execution. A 223F can take 6 to 8 months. A 221D4 can be 12 to 18 months, and that's just to initial close to get a shovel in the ground, because there are a lot of steps. The reviews are complex and they're lengthy, and you're dealing with the bureaucracy like HUD. So even though they have a time frame, it could go over depending on work. The biggest thing is, like, pack your patience with a HUD loan, because it's a process and not a race. It's going to be very methodical. It's going to be step by step. It's going to be very much hurry up and wait at some point, hurry up and get me the information, and then we wait for a response. So patience is key. Patience and a thorough understanding of the program. And that's what my job is. My job is to help the borrower understand the program in its entirety and to help with the expectations of the closing timing.
How do you make sure, say, borrower A, they feel like they can go into HUD with this amount of money and they are able to endure through 12 months or 18 months, but then maybe in half a year from now, and some of the variable changes, they don't have the finance that they needed to keep going until the HUD to get approved. How do you mitigate that upfront so that you as a lender or HUD, they don't waste time on applicants? They would basically don't have the resource to go through this lengthy application.
Yeah, I believe that it's someone like my job to vet the client as much as I can. So if you contact Draper and Kramer and you're interested in a HUD loan, I will respond. And we set up an initial meeting. And in that meeting, I always ask the borrower what it is that they're looking for and what drew them to the HUD program. And I counsel them through the entire process as much as I can. And we take various steps before we say yes to an application. So that step would be an initial meeting with myself, where I can manage the expectations and give a 30-foot overview of the program. And then what we do is we offer a free loan sizing. If we get on the phone and it's something that you're interested in, we can definitely take your T12 and your rent roll and your operating statements, and we can size the loan, in which we have another meeting. And with that meeting, myself, the borrower, and our underwriting team, we all get on the phone and we look at the underwriting that we have provided, and we make sure that we manage what HUD would expect versus what the borrower would expect, and also what we as Draper and Kramer would expect from this deal. I think that the loan sizing aspect before going to straight application really helps the borrower see where all those proceeds are going and how they're allocated. Because it's one thing to have someone tell you, but I have a lot of borrowers that kind of get a little shock after they look at a loan sizing. And then there are things that they've never even thought of pop up and they become questions. And sometimes those are the things that determine whether the borrower goes the conventional route or goes with the HUD loan. We take a multi-step process to our intake before we even get to application, because we want to make sure that the borrower is comfortable and that we're also comfortable, because once it goes to HUD, we are advocating for our borrower, and we want to be sure that the borrower wants to go through it, because we don't want to advocate for someone who's going to kind of change their mind. And then it's kind of hard for them to change their mind once they submit the application fee, right? So,
Yes.
we want to manage those up front. It's a multi-step counseling session that we go through just to be sure, because a lot of people don't know about the program. So we want to manage those expectations up front.
Learning all of this information from you, I have a thought. I mean, maybe I can be wrong. I'm just thinking it's not be a good option for someone who wants to go and purchase a multifamily, because it will take too long to close. It will be good for someone who has already purchased it. He's already operating it, and then he wants to switch the loan from a conventional loan to HUD loan, because they still have those financing from the conventional loan to sustain their operation. And at the same time, they apply for HUD, they may have to put in more operational costs because of all those upfront fee.
Yes, exactly. Exactly. We have a lot of clients that do not use us for purchase simply because of the timing. So a lot of people go conventional for their purchase, or they'll get a conventional construction loan and refinance into a cash out loan with HUD, or people will use bridge loans. Bridge loans are very common for refinances with HUD. Bridge loans are also common to use in conjunction with the 221(d)(4) program, especially if there are tax credits involved, because the timing of those tax credits come in at different periods of the loan. So you need a bridge loan to cover the loan until those proceeds start coming in. There's a whole section on bridge loans in the HUD guide to help everyone kind of figure out what the requirements are for HUD, and to work with your bridge lender to make sure that the loan is structured so that it'll be a smooth refinance process once it's ready to be refinanced out of those conventional loans.
Is this another service that you and your team can provide?
Unfortunately, we don't have the bridge loan, a bridge to HUD product on the HUD side. Our conventional loan producers have access to bridge loans, so we can do that. But it is common for most HUD lenders to have a bridge to HUD program. Unfortunately, we're not one of them. So we use other conventional bridge loans in conjunction with the HUD loan. But bridge loan is the most common that we see, and it's probably the most, I wouldn't say the easier, but it's the path of least resistance when it comes to refinancing, because we know that coming out of a bridge loan that the property is most likely in shape to be refinanced, especially with the HUD loan. Minimal repairs, things like that. HUD really likes to refinance bridge loans into permanent loans.
That's a good tip here. And how do changes in federal policies impact FHA lending and HUD loans?
They can impact them, but one thing that I will say is that those impacts don't come abruptly. Policy changes take time. Sometimes policy can also be open to public comment. I know HUD has an FAQ for lenders to ask questions about certain policy changes that they announced or are thinking about. But the good thing is that these changes, they don't come abruptly. So if a policy change happens while there's an application that an underwriter is working on at HUD, let's say, that it's probably not going to impact that loan. There's going to be a date certain that is determined forward. They may announce a major policy change, but it may not take effect for 6 months, and it doesn't affect applications until that day or beyond. So every application that was submitted prior to that change still falls under the old guidelines or regulations. Policy change doesn't happen, but the policy changes are made based upon the current lending climate that we're in. And sometimes municipalities change rules and they may conflict with a HUD regulation or a government policy. So HUD really works to make things better, and they're always refining the requirements for their own programs. For instance, there was a change in the mortgage hazard insurance requirement. And what they do is they give the lending community a public notice, and they say, we're thinking about making a change. How does the public feel about this? And then HUD will take that in consideration, and they will make a policy change, and they will give notice, and it will be a certain date forward in which that policy changes. The good thing about government policy is that it doesn't change right away. You always have a heads up, and it's always a date forward to when that change is going to be made, so that there's no surprises, and it doesn't change the order of business in the way that it's going at the current state when that policy change is made. That's one thing I think that borrowers don't have to worry about, is that once your application is submitted, if there are any changes, you fall under the guidelines from which your application was submitted. It may help ease some borrowers' minds, especially when they hear things in the news about changes. Because if you don't like the change, hurry up and submit your application, because it won't fall under that until they say it does.
How has the landscape of FHA lending for multifamily and healthcare facilities evolved over the past decades?
There hasn't been too many policy changes. The MAP guide, which is the multifamily side, that guide probably gets rewritten every 4 or 5 years, maybe, sometimes longer. That gets rewritten based on current climate and changes in the industry. HUD is always there to prop up the industry, right? If the bottom falls out, HUD is supposed to be there to grab the industry and help normalize and stabilize the industry. What HUD wants to do is to be sure that the regulations and policies from the lending environment fit the program, and they're willing to make changes to their program to benefit borrowers, but must not compromise risk. If HUD sees something in the landscape that's changing and it's going to be beneficial, they will make changes. However, being a bureaucracy, those changes take longer than expected. HUD is always looking to make their program better. They always make changes, but they don't make drastic changes. Like I said, that MAP guide gets changed every 5 to sometimes 10 years, but they put out public notices for different changes that they want to implement so that everyone is aware. So for instance, I have a good example. HUD used to have a rule that a new construction property could not refinance into a HUD loan within 3 years of completion. It had to be in service for 3 years before it qualified for a HUD loan. Right before the pandemic, HUD changed that rule to say, okay, we'll allow newly built properties to come into the program as long as they meet a certain debt service requirement between the time they submit the application to the time it closes. So that's good for borrowers who built new construction and have high interest rate construction loans that they immediately want to refinance out of. They can take that high interest rate and refinance into a 223F cash out, in which they can pay those loan proceeds back and then enjoy the non-recourse, fully amortized loan from there.
What are some best practices for maintaining compliance and ensuring a smooth HUD loan approval process?
I would say work with people who have HUD experience. For instance, myself, a HUD lender is always a good resource because they understand the expectations of HUD, and they can guide borrowers into what some of those regulations are going to be. Because once it closes, the actual onus is on the ownership itself, but what gets really scrutinized is the operations. And so Once a HUD loan closes and goes from underwriting to close, from there it goes to asset management. And HUD asset management is who would receive those reporting. So you have a reporting requirement, and they would be actually watching the property and make sure that it's complying, that you're turning your reports in on time. Sometimes they'll work with you if the property is not performing, and they may require you to hire a consultant for 12 months to help you get the property back right and get all the reporting correct. It's very much a government oversight program because there are requirements that the borrower must comply with even after closing. There is constant oversight when it comes to the HUD loan. But again, the oversight is not to micromanage the borrower, is to make sure that the residents of the property have safe, affordable housing that they want to live in. The residents are the focus of the whole HUD program.
Thank you, Jesse. Thank you for sharing all the tips and your knowledge with us. And for anyone who is interested in the HUD loan, you should definitely work with Jesse, and the QR code is here. And what the other contact methods that the audiences can reach out to you?
Sure, you can reach me on LinkedIn at Jesse Stewart. You can scan this QR code, or you can reach me by email at jesse.stewart@draperandkramer.com. Or you can call me at area code 312-795-2642.
Thank you, Jesse. And I appreciate again for coming to our show today. Thank you.